Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing our Tuesday stock buys. Now the market is currently closed on Monday, so we're going to be planning out and doing our sort of pre-purchase of our stocks that we're going to be buying on Tuesday. So every week I add brand new equity into the markets. This is used to lower my dollar cost average into the market, lowering my initial unit cost, increasing my yield on cost, and increasing my dividend income going forward for 2019. Now, initially, I may get an additional $4, $5, $6, but sometime during the year, each of these stocks that I'm buying back into raise their dividend and increase my income year after year going forward. So that's one of the reasons here. I just like the dollar cost average every week, just stay pretty active here. So if you are brand new to the channel, hit that subscribe button below. If you do enjoy the video, find it helpful, hit the thumbs up. And if you have any comments, questions, going over anything in today's video, drop it in the comment section below. I always appreciate all your guys' feedback. If you guys want to discuss stock market, personal finance, real estate, let me know. So let's go ahead and flip the screen around here. And we're taking a look at the M1 Finance Roth IRA platform. Now, I have a whole video on why I use M1 Finance, the benefits of it for a dividend growth investor, and especially as a Roth IRA. I will have a link here in the top corner if you guys would like to check it out. And also I have an affiliate link in the comment section below, description below, if you guys would like to check that out. I appreciate it, but of course you don't have to. So here within the account, let's take a look at just last week's progress. So taking a look at just the last week here between February 11th and the 15th, we had made about 2.7%. So if we're looking and comparing it to the S&P, Dow Jones, and NASDAQ, we kept right on line. The S&P up 2.5, the Dow Jones up 3.09, and the NASDAQ up 2.39. So we're right there along, keeping up with the indexes here within this portfolio. Now, as far as the 1 week performance goes, our big winners here, Stanley Black & Decker bouncing back 7.55, Lowe's up 7.28, Caterpillar up 5.91, Cardinal Health up 5.34, and so on. So we had lots of winners here. With our main losers here, only 3 this week. Altria down 0.16, Main Street Capital down 0.16, and WP Carey down 0.39. Now on Friday, if you guys watched my video, I said that I was selling out of WP Carey, only selling off the capital gains. So I had made $72 of roughly capital gains and some $40 of dividends. I captured just the dividend or the capital gains and rolled $72 from WP Carey because it was trading at 52-week highs. I rolled that down into Main Street Capital, plus I got dividends from Apple on Friday. So these $74.75 I got rolled into Main Street Capital. That is none of my invested capital. Going forward, Main Street Capital, based off the current buy price that I got it at, I'm going to be making $4.68 going forward just from the investment here that I made on Friday. That's 39 cents every single month because it's a monthly paying company that I never had to use any of my own equity for. Now, also my plan was if Main Street Capital falls, I will be averaging into this one as it's kind of following down because I only have 74 bucks into this. And if it goes down, I'm going to add a little bit more. If it goes down more, I'll add a little bit more. This is a great company kind of going forward here. We can see that it has really good history, growing and paying out a dividend. It started paying out back in 2011 and has grown and paid out a dividend since that point. We can see here that there is a little bit of a cut down, but that is because they went from quarterly to monthly, and they have some very nice special dividend payouts. And inside of the Roth IRA, it's a tax sheltered account, which is perfect for real estate investment trusts. So all these dividends that are paid out to me, I don't have to pay any taxes on them. They just stick inside of this account, and at 59.5, it is 100% tax free. So really good benefits here of the Roth IRA. So I have a whole video on that as well. If you guys would like to check out that top corner, I will try and have that linked up as well. So I will be buying Main Street Capital this week. That was one I wanted to focus on if it went down. And I wanted to sell off WP Carey because I knew and figured this one would go down slightly just due to being at 52-week highs. I also want to continue adding into Altria. This is a company here that is making some really good acquisitions. I believe that cigarettes are on a downtrend, but they're moving into Juul, the smokeless tobacco. They're moving into marijuana, the weed industry, which I think kind of going forward over the next 5 and 10 years, yes, cigarette sales may decline, but they're making these moves now that going forward, this is going to benefit them in the long run. So I would like to take advantage of their current discount as far as where my portfolio, my buy price, when I originally bought into the stock, I thought it was a good buying opportunity. It has now offering me an even better opportunity. We can see that in my portfolio, Altria is down 23.82%. So it offers me a good buying opportunity from where I originally said, hey, this looks like a good stock I want to be holding over the next 5 and 10 years. And I'm not buying a lot of these stocks. Yes, I do care about capital appreciation, but I want stocks that are going to continue to grow and pay out a dividend. That way, when I hit 59.5 or 60 and so on, I don't really have to count on the capital appreciation. I can just mainly take the dividends that I'm collecting every month, whether it's 1,000, 2,000, 3,000 every month. I'm able to just collect that, not take or have to sell off any stocks, and the shares will just remain in the account, paying me out dividends every single month tax-free. And when I do kind of croak the bucket, hit the bucket, anything within the Roth IRA would then go to my trust or whatever, and it would be 100% tax-free. So as long as these companies continue in their financials moving forward, they continue their growth and get into new acquisitions here for the future, they are at a good opportunity. So Altria, AbbVie here, AT&T, Caterpillar, Kellogg's, Avery Dennison, JP Morgan, Apple, Lockheed Martin, Stanley Black & Decker, and Main Street Capital are my current negatives in my portfolio. Now, I know I want to be adding a little bit more into Main Street Capital. Main Street Capital is going ex-dividend here on February 20th, so that is this week. That is Wednesday. So I'm going to be adding brand new equity into the stock here on Tuesday, and it's going to go ex-dividend on Wednesday, meaning that I'm going to get paid out some nice dividends. I'm going to make roughly, 40 cents, maybe a little bit over 40 cents here with Tuesday's buy plus the dividends or the stock here, the equity that I already have in it. It's going to be making me about 40 cents every month going forward. Plus, it's going to just reinvest into other stocks within the account by fractional reinvesting. So Altria is one I'm going to be buying. I would like to pick up some more Apple. It's at AT&T. It's at that $30 point. Now this is a 1, 4, 7, and 10 paying stock here. Apple, I said it again. AT&T is offering a 6.7% yield. Pretty good payout ratio. They've made an acquisition here with Time Warner. They've had 34 years of growing their dividend. Now my buy price for Apple is right around $35. So buying it back here at this $30 point, it's offering me a pretty good opportunity. I'm not planning on adding a whole lot more equity into this specific stock. You can see here that the value of AT&T is already at $5.28. So I may add, I may split this week's up by 5, and I may end up buying about $20 or so of AT&T just to kind of average down slightly here and just increase the overall dividend income going forward. AbbVie is another one here. Within the last week here, if we look at the week performance for AbbVie actually did fairly nice this week. See if I can find it here in the list for the week. AbbVie at 1.48%. I believe kind of going forward, they're kind of done with their rut. They went down nearly 10%. Now they're starting to bounce back. They didn't make as much of a return this week versus others, but I believe kind of going forward, AbbVie's in a good position. It's a split off from Abbott back in 2013. And their own history here shows 46 years of dividend growth since 1973. But that is because they kind of carry over from Abbott. So Abbott down here, AbbVie only has dividend history here from 2013, but they've had really good growth over the last 10 years. Abbott here has an average growth rate of around 16.75% over the last 10 years. I don't know if that's sustainable. They'll probably have to cut it back slightly, but they're still offering a pretty good buying opportunity since when I initially bought them. AbbVie is also a 147, what was it? I believe it's 1.4. Yeah, 1, 4, 7, and 10 paying stock when it goes ex-dividend, and then it pays out on 2, 5, 8, 11. So it's not going ex-dividend again here until April, so I could kind of hold off on this one if I do believe it may fall back a little bit more, but we shall see what else is out here. Lockheed Martin. Lockheed Martin is down in my portfolio by about 2.67%. It does have a high equity stake. So I'm going to go ahead and just, maybe we'll split this up a couple of different ways. So Main Street Capital, Kellogg's was one I want to be buying back into. AbbVie, we can add a little bit more into this one. Caterpillar here, this one goes ex-dividend in 1, 4, 7, and 10. So another 1, 4, 7, and 10. Now this one's history here. This one shows that it only has 9 years of dividend growth since 2010. If we take a look at the 2010 period right here, all they did here, they didn't cut it. They didn't, discontinue or any sort of thing. They didn't raise it, obviously, but here they just kind of froze it out. They were paying out 42 cents per share here right after the recession. They did raise it. Then they said, hey, let's go ahead and hold off on raising our dividend. So they held off on raising their dividend for 2 years. Then they continued. But here, just a few years prior, they had done a stock split. So if you were making $100 in dividends with your shares, you were probably making out $200 in dividends. And it just made sense for them to kind of freeze it in place and just kind of continue paying out the dividend but not cut it back, such as what CenturyLink and General Electric have done. So I think this is a good company kind of going forward. The 9 years of dividend growth, that's fine, because I know during recessions they may freeze it, but I will keep my yield on cost here of around 2.53%. So that's pretty healthy. So I think what I am going to do is I'm not going to be splitting it up 5 ways here. I do want to be buying some more Main Street Capital. I do want to buy some more Altria and Kellogg's and Caterpillar and AT&T. Boy, there's a lot of companies here that I do want to be buying. Main Street Capital is not offering the best buying opportunity, but I did want to just add a little bit more equity into this one. So I am going to go ahead, and how much equity do we have here? Okay, so we don't have very many cash sitting on hand. I just used it up Friday. So we have 1 cent sitting in cash, and every single week I add $115.38. So that's kind of going in there. So $115.38. So it's basically $115.39 here. I'm going to go ahead and split it up 5 ways. So that is $23.07. So the companies here that I'm going to be buying is Altria. I'm going to be buying $23.07. Continue there and confirm. And I'm going to go ahead and also buy Main Street Capital. That should put me over that $25 point here for Main Street Capital. So I'm going to go ahead and target this one and buy, sell $23.07. Continue and confirm. Now we also wanted Lockheed Martin. So Lockheed Martin down 2.67%. Going ex-dividend here shortly. Buying in there 23.07, 23.07. And we also had, go back to our portfolio here, Kellogg's. Kellogg's was another one here. This one's not going ex-dividend again here until about the very beginning of March. So this one should be going ex-dividend. They should announce ex-dividend date here very shortly. So we're going to be picking this one as well, adding a little bit more to it. So that would be 23.07. And now we've currently confirmed 23.07 times 4. Whoops, 23.07 times 4. That's $92.28 minus $92.28. So our next stock buy is going to be $23.11. I'm just going to make it a straight exact dollar amount because that way I can roll everything into these. Now my last and final stock, I can pick between Caterpillar, AT&T, or AbbVie. So AbbVie here, AT&T, so AbbVie, AT&T, and Caterpillar. So which of these 3 should I pick? They're all 3 of them down right around 10 to 12%. So AbbVie, could it offer me a better discount here between the next 2 months or so prior to going ex-dividend? Here, this one's also right along there as well, another 14710, 14710, and Caterpillar here is a 14710. Now, of all of these companies, they all have good dividend history. This one's showing only 9 years, but again, they just kind of held off and didn't raise it through a year. Let's see, as far as equity goes, I believe AbbVie is the lowest in equity here. Oh, Caterpillar is. But I still want to lock in that nice yield. So I'm just going to make the decision here and go with AT&T just because AT&T, I believe it has a good buying opportunity around this $30 point. I should have bought AT&T at $30 versus where it is now. Where I had initially bought it at, not right now, but where I had initially bought it at, that would have been a better opportunity. But when I initially started my portfolio, I just took a large chunk, deposited in there, and I was brand new to M1 Finance. And when you add equity into your portfolio to fund your account, if you don't specifically mark what stocks you want to buy and you tell your portfolio here that you want everything auto invested over $10, M1 Finance will just take your cash and invest it into your pie. Whatever pie you have made, it'll invest it into that. So I did not know that, and I just bought every single thing here within my portfolio. But overall, it's worked out. Everything's positive still. I'm still making all those dividends month after month, week after week, and it's working out. So now we have every single thing here kind of confirmed. If we go back through here, the portfolio, we're going to be buying this week Lockheed Martin, which is going ex-dividend here very shortly here on the 28th. We're going to be buying some more AT&T. We're going to be buying, so we can just sort this by losses here. So Altria, AT&T, Kellogg's, Lockheed Martin, and Main Street Capital. Those are the 5 stocks we're going to be buying this week. They're all in the negative right now, which is going to allow me to lower my unit cost, increase my yield on cost, and increase my dividend income. This right here could possibly increase my dividend income by another $5, $6 kind of going forward. So I will be posting all this information on Facebook every week. On Facebook, I post what stocks I bought, where I bought them at, how many shares, and then how much my dividend income increased for 2019. So if you guys aren't following me on Facebook, check it out. Check out my Facebook page on the comment section and also in the description below. And if you guys are brand new to M1 Finance, I highly suggest checking it out. There is a link here in the comment section, description, if you guys would like to check it out. It really helps out the channel, and I appreciate it, of course. So that is it for today's video. If you guys did enjoy it, hit that thumbs up button below. If you guys are brand new to the channel, hit the subscribe button. And if you have any comments, questions, if you guys are buying some stocks this week, drop it in the comment section. I always appreciate all your guys' feedback and seeing what stocks other investors are buying. I've seen investors going out there and saying, hey, I'm buying some Coca-Cola, I'm buying Microsoft. Coca-Cola took a 7% dip, a little over 7% dip. That could be a good buying opportunity, but I myself, I do like Pepsi. I don't like Coca-Cola just because they're in sugar drinks, but they're a little bit more diversified there. I just believe they're a little bit tougher, as far as trends. You can't just buy those old companies just because they're old. You have to look at their progress kind of going forward, just like I've done kind of with Altria. So that is it for today's video. Thank you all for tuning in, and I will see you next time. Have a great day. Bye.